We've got Pardeep, new to the show. Pardeep, welcome.
Thank you.
And we've got Reese, who's a regular member to the show. He's smiling, unlike his picture on the poster. So thank you very much. But first of all, Paul Preston, over to you.
Thanks, Chris. Thank you very much. So yeah, thanks for everyone for taking time. I just wanted to give a bit of an insight into how we onboard projects. There's a lot of due diligence that goes into obviously what we do, and I think very often that people look at a shiny brochure and they look at the details of certain projects, and if it looks good, it could make its way to be a good investment. But I just wanted to talk for a few minutes before I hand to Reese about the depth of due diligence that we do and just highlight some of the key areas that we look for when we onboard projects. We have a 20-page due diligence document that we use, and a few pages demonstrated now on the screen. And within that, we cover basically everything there is to cover, all the good things, all the negative things. We like asking detailed questions. And the reason we do that, number one, is to protect the investors that invest through us, as well as every transaction that we do, and the two projects that you'll see today relate to this. We forward commit financially to secure these projects. So if we were just taking a development from a developer to sell it, which we see a lot of people do, they've got no financial commitment in there. It can easily be just a quick yes because the project looks good, the numbers seem to add up, but really that's just the start of what people should be looking at when they invest into any residential or commercial assets. So again, a nice glossy brochure here, the front page of something aesthetically looks very good, but the real detail is all within the due diligence. So a couple of things that we look for. Number one is a basic element is the proof of funding. We want to see that the developer can afford to actually build this, whether that's from cash in their bank off the benefits of their track record of being successful, or more likely the proof of funding that they have with a lending house for development finance purposes. So we want to see that detail. We know what the gross development value will be on a project. We just need to make sure that all of that funding's in place to be able to deliver the project. And again, that's a key criteria, and that's pretty much the starting point of where we start our searches. Some basic things as well, any ongoing court actions against the developer. Again, this is something that can be easily overlooked. We need to know that, because if there is court actions against the developer, ultimately they're elongated, they take forever to resolve, a couple of years on average, depending on how severe the issue is. But they also take up a lot of time focused and a lot of money, which generally can be used and other projects suffer. So the funding they could have in place for a specific project, they could be using some of them funds to make a bad situation better on previous projects. So we just need to make sure that they've got a very strong track record and there's no debt or legal actions hanging around their necks. And again, some things like any delayed or mothballed projects. If there are mothballed projects, you won't see them online anywhere. The developers won't tell you about it. So when again we do our deep dive into due diligence, we need to make sure that everything they've said they would deliver previously has been delivered. There's also a big element of when clients exchange. Generally, we won't go over any exchange amounts over 20%. So when clients invest through us, the maximum exchange level that we will allow with developers is 20%. And when you do that, there's an element, there's two terms. One's called stakeholder and one's called agents. And that's how money's held with the developer. If the monies are held as stakeholder, that means that the 20% exchange deposit cannot be used by the developer. If it's held as agent, then the developer can use all of that money to do whatever they want to do with that. So where we go in, the developer needs money to obviously build it. Certain fees need to be paid away. So we like where ideally everything is held as stakeholder, but very rarely that happens. Even with the big developers, they can't afford for that to happen. So we want to have an element where a maximum of 10% is held as agent, which means they can use 10%, and then the other 10% is held as stakeholder, which is essentially in an escrow that the developer can't touch. So that gives our investor security that if there are problems, and there shouldn't be after we've gone through this due diligence process, but if there are, then at least some of your money's protected, because most things that we do are off plan, i.e. a year or 18 months off plan. So clients exchange now, and then they pay their balance obviously through a mortgage come completion. So through that build time frame, a lot of things can go wrong. We just want to make sure that we tick all of these boxes, do our checks properly to make sure that our investors get a good product delivered on time and in line with the timeframes that the developer sets out initially.
And also, Paul, can I mention, and we've had a load of people jump on at the last few minutes, so thank you and welcome everybody. We've got Darren on as well. He's the property expert, and Paul, I guess Darren and Donna, the mortgage experts, are part of that DD as well.
Yeah, and obviously from a Holborn perspective, no project, whether it's through Global Residential or anyone else, can ever be launched without the approval of International Property Finance Group, Donna and Darren. And every project, we have a very close relationship with them. Every project that we do, they send us a lending pack, which is basically, it's a one-pager of all of the approved lenders that will lend to our investors on these schemes. And we also have with that how many units or what percentage of the building each lender will lend to. So we just need to make sure if there's 100 units in a project that our panel has the depth to allow a minimum of 100 mortgages. So it's a big part of the process. Ultimately, projects, it's all about completions, and a mortgage, there's most moving parts, because you know that better than most people. There's a lot of moving parts in mortgages, but the guys roll their sleeves up and they do everything they can for their clients. And we look at this way before we ever invest into any project, right from the outset. So it is a big part of it. Mortgages are, let's be honest, they're getting more and more challenging. They definitely are. Reece will talk about interest rates and some of the challenges with that as well. However, the guys at IPFG do more than any other brokerage company I've ever worked with to get things done in the time frame they need to get them done in. So yeah, I agree, Chris, that the lending side's massive on that. And linked to lending as well, and this is my final part on the DD, but there's a document, a certificate called the EW1S, which basically relates to cladding. And even on buildings where there is no cladding, believe it or not, some lenders will do their site appraisal, they'll go to sites and they will give down valuations or even zero valuations if the EW1S form's not there. So I don't know how familiar people are with EW1S. Again, people can just look at the aesthetics of a product, the price, and think that makes sense. But there's so many moving parts, and that EW1S, if it's not there on completion, then rest assured you'll have severe challenges with lending. So again, whether you invest through Global Residential or someone else, it's just really important that people look into the due diligence and you ask the questions that you need to ask, because again, there could be big downsides come completion if some of these things are not in place.
We actually double check that as well, Paul, because we've had it in the past where EW1S forms have expired. So then the lenders are going to need new ones. So we're just making sure that those are in place for the lending completion. Yeah,
exactly. And again, even where we've been told EW1S is not, we don't need it, we're not taking projects on if that document's not in place. So it is a very poignant topic at the minute as well. Right, Reece, I'm going to hand over to Reece, who's my partner within Global Residential, and then we'll hand over to Pardeep, we'll talk about the rental market. But just before I do that, we're an end-to-end solution. So we've talked about the due diligence, we have the property sales, and then we also have the lettings and management on the back end. And when we take a project on, Pardeep runs their own rental analysis. We think it's vitally important that we give our own analysis on what the rental market's doing. And we're pretty much led by the rental demand in a certain location. We only take projects on in the right locations where we see value and affordability, number one. I think this is a picture of Manchester, what we're looking at now, but Manchester's transformed massively. It's still a strong market, but there's lots of stock and new buildings gone up in the last few years. The rents have got exceptionally high, to a point where it can get unaffordable for a lot of people now. And we're seeing people move from central Manchester into locations like we've got today, Bolton, which is Greater Manchester, just from a value proposition. If people can be 18 minutes on the train from where they're living into Manchester city centre and they're paying half rents, then that's what people are starting to do, just because that affordability element, and a lot of extreme areas in Manchester have just gone away, and people just can't afford to rent, or a lot of people can't afford to rent in these locations now. So affordability is massive, and the work that Pardeep does on the front end of a project is really important to us, because we need to make sure that the affordability element, that the people that will rent these properties can afford to do that. So again, another big focus for us when we onboard projects. But I'll hand over to Reece, who's going to talk you through two schemes. One completed scheme in Bolton, exceptionally high yielding, a nice quality finished product, and then also a project in Burton on Trent, which is 9 months from completion from where we are now, but a lovely listed conversion right in the city centre of Burton again. Both projects demonstrate significant value. So I'll hand over to Reece to talk you through both of those schemes.
Thank you, Paul. So yeah, I think for me, I'm just going to cover off some headline figures, obviously why property, but really kind of trying to bring it in line for what we're looking for as a business. And the key message is trying to get ahead of the curve. Like Paul mentioned, we've been active in the likes of Manchester, Birmingham, Liverpool for the last 5 or 6 years. And even though regional cities are still performing, kind of given where inflation is currently, which I will cover off, we're looking to try and offer clients the most efficient investment propositions based on the current climate. So to start off, why clients really do like property over any other asset class. The first is that you can get both growth and also yield on that asset. So if you are a cash buyer, not only are you getting the gross income, which acts as the yield, you can also still generate growth on the property appreciation. However, that gives you the ability to use mortgage finance, meaning that if we are buying in the right areas, typically you can have a tenant pay for your mortgage costs and really play that leverage game that hopefully over the medium to long term should give you a significant return on your cash. Also, given that it's a tangible asset, you can touch it, feel it. It does have multiple uses. If you are maybe a British passport holder and plan on moving back to the UK, you can still use it to physically reside. But I think the fact that it is a tangible asset does really give clients a lot more security and reassurance on buying in it. Hence why the property market is very resilient in kind of uncertain times. Political issues, you'll see stock shares, crypto really bounce around. You won't get that with property. So talking about the UK average house price, last year we saw an average of £24,500 of an increase. And that was an average house price increase of 8.4% from the year 2021 up to June of this year. Now, why are we still seeing this growth? Because again, we are still coming out the back of the pandemic. Again, there was a lot of speculation that going into COVID, that house prices would simply crash. The underlying factor that really underpins the UK is that we still have extremely low amount of supply versus high demand. And the demand is not only coming from overseas investment, buying residential buy-to-let properties, it's also given that we're expecting a population to surpass 70 million people, that there is simply huge demand and not enough supply. The government have set targets to deliver over 300,000 units per annum. And year on year, that's a compounding issue that is simply not going away. Now, I have mentioned low interest rates there. I will talk on an economic kind of overview that interest rates have increased, but historically they are still very low and attractive. Darren can mention about trying to have the ability to lock in interest rates now. And given that we're looking at between a 2 and a 10-year fix, there's not that much of an increase, an incremental difference. For investors looking at projects that are complete, which we have available today, I think we can still take advantage of fairly low interest rates. And then finally, inflation, which is probably at the top of everyone's mind when investing. If your cash is sat in the bank, it is theoretically eroding away. But how does inflation really kind of work against when you are buying into property? I mean, property values tend to keep up or even outpace inflation, especially when it's high. Hence why we have seen the growth levels that we've currently been seeing. So a quick snapshot on the economic data. Like I mentioned, this is an inflation graph dating back to 2012. We're at the highest rate of inflation in the last 40 years. So now more than ever, it is important for clients and investors to really understand where to allocate their money. Now, given where equity markets are, the crypto market is, we are really bullish on property, whether you're buying in cash to generate an income or whether you are still using mortgage finance. Because inflation, if you are locking in a mortgage at today's rate, even though if your cash was sat in the bank, inflation would be eroding away your physical monetary or liquidity. If you're locking in mortgage rates, that has the same effect in the medium to long term, but theoretically your cost of borrowing is actually going down. So using mortgage finance or buying property out in cash right now, I think is more poignant more than ever. And again, in terms of the base rate, that has increased 5 times since December of last year. So it was at 0.1%. We're now at a base rate of 1.25. But Darren, I'm not sure if there's anything that you want to kind of mention in terms of typical interest rates for UK buyers based in the UK or offshore clients looking to get an expat mortgage buying UK property. I don't know if you want to.
Yeah, there is a big difference between. So the average UK person buying a property in the UK, the interest rates are averaging around about 2.25% to 3%, obviously depending on situation, value of the property, etc. Expats, on the other hand, are probably another 1.25%. Obviously depending where they are in the world, but we're seeing sort of average interest rates for expats closer to the 4% mark now. And the increase in the Bank of England base rate increasing it is a bit like death by 1,000 cuts, if you like. I don't know why they just go, we'll just increase it by 1% and to see how it goes. But these small increments are having a massive effect on the property market, which it's not slowing down, which is great news. But they're just trying to control the process. But yeah, the average interest rate anywhere between the figures I've already mentioned, Reece.
Which is why, again, I think it is important if we are looking for properties from an investment standpoint, they really do need to be kind of in excess of 4.5–5% to make mortgage finance look attractive, where your tenant will be paying your mortgage costs. Then finally, for me, just on a bit of economic data, what is important is the house price to earnings ratio. Now, this is taken into consideration back in 2009, wage inflation versus the average property price. Now that is increasing, even though we still have wage inflation in the UK, the cost of living and the cost of an average house price in the UK is on the rise. So for us, we're trying to identify areas that are going to be sustainable in the medium to long term. Now, what this graph means is if we're looking at 2009, let's say, for instance, the average income was £50,000 in the UK. The average property price would have represented a £250,000 purchase price. Again, kind of fast forward to 2022, we got to be a bit more strategic in terms of what we think can be sustainable from an investment standpoint. Again, this is something that Pardeep might want to touch on, but from looking at particular locations, and Bolton and Burton are most certainly that, the biggest point out of this Zoopla report is looking at how rental increases have changed over the past year. And on average, rents are up 11%. But the biggest point for me is about affordability. Now, 37% of the average income in the UK would be contributed towards your rent. Now, again, if we are looking at price growth of 8, 9, 10%, like we have seen over the last 4 or 5 years, we've got to look if that's going to be affordable in these tier 1 cities. Pardeep, I'm not sure if you want to comment on kind of anything with the projects that we have available and anything on the UK in general with activity, etc.
Definitely, thanks, Reece. So like Reece mentioned, we've seen a really good annual upward increase in rents across the UK. It shows the rental market is really buoyant. We've recovered definitely from COVID. And with that affordability figure, 37% of wages being spent on rent, it means that people are now looking at areas outside of city centres where they can get a little bit more value for money. So we're seeing that, areas like Central Manchester, rents are really high, affordability isn't matching up. So areas like Bolton are becoming a lot more popular for tenants, Burton as well. Again, mentioning COVID, big open spaces that we see in Burton, great natural parks, rivers, all of that is becoming a lot more popular. So we're seeing a big drive of tenants outside of core city centres.
So I'll pass on to Pardeep and on a couple of slides on the project specifically with your rental appraisals. But if you are an overseas investor looking to buy UK property, just as a buying opportunity, I think a currency play is definitely worthwhile taking into consideration. Now, this is assuming we were looking at £100,000 GBP FX transfer, so dollars into pounds. If we were looking back in July of 2021, to buy £100,000 would have cost you $139,640. Fast forward to a year, July this year, still buying £100,000 will cost you $121,169. So basically a 15% discount just on a year saving on the FX transfer. So if we are looking for a medium to long-term hold, I think you've got to be conscious on what currency you're currently sat in, if you are looking to maybe diversify. But looking at the UK from a US dollar perspective looks very, very attractive. So with that said, where to invest now? We still do feel that regional cities offer value in certain areas. They have been performing the best. If you're looking at the likes of Nottingham, Manchester, Liverpool, they are in the top 4. But for us, we need to make sure that it's going to be sustainable over the medium to long term. So for us, we are still focusing on regional cities, but now looking at commutable towns and secondary cities that have the same amount of investment allocated to the city for future growth. And this really then comes back to a lot of articles and blogs that we as a company put out there, and we're dubbing it as the first movers advantage. Paul and Chris can probably vouch 6-7 years ago, we had to try and educate the likes of Manchester for overseas investors who weren't familiar with Manchester, always would gravitate back down to the capital. So we had to go against the usual trend. However, this is what we were looking at for the last 6 years. If we're taking Manchester, the hub of Northern Powerhouse, as a comparison versus the UK on average and London. And over that 6-year period, we've seen around about 48% uplift on property prices, which is more than or about double from what the UK and London saw over that period of time. Now, this data was taken from the UK Land Registry, so it's not biased opinions, which is great if you were investing back in 2015. But for us, we now need to try and find new opportunities in areas that we can expect to see similar growth rates to this. So this brings me on to the first project, which is Lincoln House. Now, this is a completed project in Bolton, which is Greater Manchester. So I think with Pardeep being on the ground, and because this is a completed project, we put a lot of time and effort into the rental appraisals before we made a decision on to taking this project on. So I'm going to pass over to Pardeep just to talk about the actual location, really about the rental profile and where this project is located.
Great, thank you, Reece. So we've been on site here a few times now. The development's looking great, and it really is a fantastic location. So we can see here that Bolton Station, it's about a 5-minute walk away, and that leads you into the core city centre area as well. The university is about a 5-minute drive away, and then we can see Manchester Superstore there is about 10 minutes away. So all in all, great connectivity around Lincoln House, easy access to the city centre and amenities for tenants. The good news as well, tenant-wise, is that Bolton is Greater Manchester's second largest employer, second to Manchester City Centre, of course. So some of the big names, big employers in the area, we've all heard of the likes of Amazon, Aldi, Coma Group, Lidl, Warburton's as well. And Logistics North employs about 5,500 people on their Bolton site. So all in all, we've got a really strong tenant base of working professionals here to draw from. And as well as the connection into Manchester being only 20 minutes, we've got the overflow of tenants coming, working professionals from Manchester City Centre itself as well.
So I think just to reiterate what Pardeep mentioned, connectivity is great. This is Greater Manchester, so an 18-minute commute in terms of property prices and rental prices being close to 50 to 70% of an uplift. It makes it an interesting proposition from an investment standpoint to get more bang for your buck in terms of property value, but that also results in a higher gross and net yield. In terms of inward investment, Bolton itself is due to receive 1.2 billion in terms of a regeneration program. Now that's the master regeneration project. Currently, in terms of what has been approved, is Crompton Place. Now this is a £250 million regeneration program, which is approved for planning for 64,000 square meters of hotel, homes, office space, retail, leisure. Again, just really kind of amplifying that profile of tenant being the young working professional, and moving outside of kind of the industrial and retail space, but more in terms of your young working professional. To talk on the project, as mentioned, Pardeep and Paul have been on site many times. So this was taken a couple of months back, just when all of the kind of snagging was looking to take place. But I'll pass over to Paul because this is a developer that we've worked with on three. This is now our fourth project, but hopefully you can get an idea in terms of the actual spec. But Paul, I'm not sure if there's anything more you want to add on from actually going on site and Pardeep on the project itself.
Yeah, it's a good time really to sort of my opening comments on the due diligence. This is our fourth project with this developer. They're a UK listed developer, so they're on the stock exchange here in London. So phenomenal track record. They've had challenges with a few sites, but the great thing is that when there are challenges, they tell us about them and we can work together to resolve them, which is great. Not a lot of developers do that. They like to put their head in the sand and hope the problem goes away. So every project we've done with them, they've delivered it. Again, if there's been challenges, they've informed us, we've informed clients. And it's just a nice relationship with people we enjoy working with, very well capitalised. And similar to sort of our model as well, they're looking for pockets of value. They've done a lot of buildings in Manchester. Obviously, this is 18 minutes away from city centre Manchester, so they like this location. We've got schemes in Sheffield and other markets as well. So they're a developer that always deliver. They let us get on with the sales and then they go and build the projects out. So it is a good relationship and we'll definitely be doing more with One Heritage moving forward as well. Just in terms of what Reece was alluding to, personally, I've been selling central Manchester for the last 10 years. And I always remember the first project we did there, it was £220 a square foot in Wilburn Basin. And again, that was probably 9 years ago. We did the assembly with a big developer as well. And again, that was less than £300 a foot. What we've seen in city centre Manchester now, and I'm not talking city centre Manchester down, we will continue to do deals there when the values are right. But there's some projects now, they're over £550 a square foot, nearly £600 a square foot. So it just shows you the market's jumped a lot for all the right reasons. It's a phenomenal place. It's been transformed over the last 10 years. There's so much going on there, but there is a lot of supply. And we have, in again, certain pockets of Manchester, we question the affordability from a tenant perspective. It can be the best apartment that people have ever seen. But if it's too expensive for people to rent, then you'll be paying your own mortgage. Your tenant won't be because it'll be vacant. So we're really trying to focus on locations that have the potential to appreciate over the next 10 years, similar to Manchester has in the previous 10 years. And we're transacting here, the retail price for these projects are less than £250 a square foot. So it's kind of where Manchester was 8-9 years ago. And what we're also hoping that will happen off the back of Reece's previous slide with all the government spending, the private spending, 1.2 billion being invested into this location. So we know already how different Bolton will look in 10 years from the way it looks now. And we know that these values simply will be nowhere near the prices that will be in even 5 years down the track. So it's got all the right dynamics. It's very well situated. There's a lot of value there. People are renting properties here, one beds for less than £800, £750. It's affordable. They're a good spec. And this project is right on the edge of the city centre. So a short walk into town, a very short walk to the train station as well that takes you into Manchester, and located in an area where there's a huge tenant demand. Because this building is already complete, these are the rents. We know what rents are being achieved. So these are not guesstimates of what they could be. These are the rents that are being achieved, which again, really helps investors make that decision because they're real numbers. They're not done in hope that they will be this level when it completes. It's a completed project. They're renting. The average property's on a market for 48 hours in this project. So very strong rental demand, a real good yield in a quality product that will appreciate over the next 5 years.
Paul, a question's just come in at the bottom of the page. Somebody just asked about the studios and mortgageability, and I just thought I'd ask Darren to give a view on that.
Good.
Yes, so the studios are going to be a little bit more tricky. Most lenders will say they have to be above 35 square meters, so I'll have to do my maths in a bit. But you can still, there are still some lenders, but it is very, very tricky to get studios with mortgages. But I'll do my maths in a minute, and I'll come back to you on that question, Chris.
Okay, another question's just come in, Paul. So we're going to have to. I'm going to ask it now anyway. Just to sort of mix it up and confuse Paddy. You've obviously famous for the yield invest, and Heinrich down in South Africa has said, "What's the latest? What's going on?" Just thought I'd just break up the presentation and annoy you.
That's fine. No, you're welcome. So no, yield invest. It's obviously it's the strong lease as you'll get. It's a minimum of 5-year lease, government backed, so very strong lease. And what people are buying there, they're buying income. So they're all cash transactions. It's a very similar price point to what this is. So they just sit alongside each other quite nicely. Yield invest, it's all cash, and people are buying the strength of the lease. In Bolton, the units are mortgageable, and when Darren gets his calculator out, he'll see that these are over 35 square metres.
Yeah, they are 38 minimum.
Well done. So we're safe on that as well, but these are mortgageable. So they're similar in terms of price point. The yield profile is very similar. Does this have a 5-year government-backed lease? No, they don't, but they're in a hot location where there's an extremely strong rental demand, and they're mortgageable. So I think that's kind of the differential. And with yield invest products, again, people are buying the strength of the lease. We're not positioning yield invest as a product that they're going to double in value over the next 10 years. But again, with all the research that we've done on this particular project, the expectation is that they will double in value over the next 10 years because of the location, the government spending, etc. So hopefully that's answered the question there. But yeah, yield investing is our fastest selling product just because the strength of the covenant on the lease.
And guys out there, you can reach out to Global Residential or via me if you've got anything on that. So I just rather interrupted that presentation. I apologise for that. So Reece, back we go. Sorry.
No, it's a great point, and I think look, it's just genuinely where the market's at. I mean, because everyone is mindful of where inflation's at and wanting to try and hedge against it. If you're buying a social housing product with a government lease that is linked to inflation, it's a cash purchase. It does exactly what it says on the tin. It's a great product. Comparing it to something like Bolton, purchase prices are exactly the same or very similar kind of profiled, but you have the ability to be in control of it. And given that there is a lot more government spend in these kind of locations that we're looking at, I mean, to look at a 1-bed at 626 square feet, I mean, that's a considerably large apartment in the UK. So we are trying to look for value and really give clients a number of options in this current climate. And I think stuff that's closer to completion, getting your cash working from day one is what we found has been of most interest at the minute.
Reece, I was just going to say one thing. And this presentation we're doing now, we've got over 100 people watching right now. So thank you very much. And do you know what? It's because we've listened to what wealth managers and clients have asked for. They want completed, and this is obviously completed. And when you go on to Burton upon Trent, 8 months, that's what people are asking for, and that's why we're bringing it to them.
Exactly. Yeah. There's a theme for both. Obviously, Bolton's completed, and we're sort of 8 months away from Burton being completed. And Burton's a very active site. Just go slightly off tangent, but as a business, we're not only looking at value, we're looking at massively de-risking all of the investors. And Chris, we've all seen what's happened in the market, since Brexit and a few other things. Materials have gone through the roof, and construction costs have just escalated exponentially to the point where there's a lot of developers over the last 6 months, and it will happen to more of them in the future, that they just can't build now for what the prices they sold at originally. So if someone bought 2 years ago off plan, it's extremely difficult for the developers to build and make profit because the costs have gone up so much. So we've seen a few projects, thankfully, not ours, but we've seen a few projects that developers have to go back to investors and say, look, we just can't build it for the price you've paid. You've already exchanged. We cannot deliver it. So you either pay more or we'll have to resell the unit for you, and then we'll pay you your monies back at that point. So having something that's near to completion, obviously this is complete, or something near to, that development risk factor is almost totally mitigated because he's built it. It already exists. It's already there. So it's a safe haven for investors. And both of the schemes you'll notice are conversions. This is a conversion from office space into residential. But if that was a clear site, the developer wouldn't be able to build that out of the floor now for less than £300 a square foot. So again, these PD schemes, as we refer to them as offices or commercial into residential, they've bought the existing building. The cost to deliver them on a per square foot basis is a lot less. So therefore, clients are getting a lot better value. So again, that's been at the forefront of when we're spending our money, we're looking for these opportunities to bring to investors.
A question just come in, car park optional on those one beds?
I see that come through. So yeah, it's optional. We would definitely say, because look, the tenant pool, like Pardeep mentioned, being kind of, again, with 5,500 employees from large corporations, I think it's really going to enhance the rental return, i.e. your gross yield perspective, but it's optional. £15,000, which if we are comparing it again to the likes of Manchester, I mean, they're a valuable commodity. So even though we have some allocated here, I just wanted to talk through this price list. This was just an example on the third floor. But yes, parking spaces are optional and they can be purchased with studios if there are still any remaining.
And that is part of, sorry to interrupt, and that is part of the mortgage as well. So you would get the purchase price, add on the 15,000, and maybe a question for Darren, and then you get 65% on that. Would be about right?
As long as it's on the same title deed. If they're separate titles, then it'll be two separate transactions.
Just say yes.
Yes, Chris.
Pardeep, you were going to say something.
Yes, just on the parking from a rental point of view, it's really important. And all of those large scale employers that we mentioned, you know, they're all within a 10 to 20 minute drive. You know, the hospital's a 5-minute drive away. These people that are going to be working late shifts. The higher end of the rental market that we're targeting, because this is a good, really high spec scheme, have the disposable income generally for a car. So you have a parking space with your unit, you're going to get a higher yield, more rental income, and it will be rented first. So definitely worth it.
And just from a resale aspect as well, if you're looking 5-10 years down the line when the market's appreciating this location, for people that want to sell, it's a very good commodity to have. If you've got a car park space, you'll sell it a lot quicker than if you didn't. So again, just looking forward into the exit strategy, if you had one, that would help.
Well, I think, again, kind of comparing it to Manchester, on some sites that we've seen, you're looking at £25,000 to £30,000. So just that and an uplift on a separate title deed itself is, again, a valuable commodity. So yeah, parking spacing is optional and available. Moving on to the next project, again, a similar kind of investment case scenario that we're looking to try and get ahead of the curve. This is the Plough Maltings in Burton. Now we've got a quick promotional video, which I'll just play, just so you can get a feel for what the development will include and offer.
Reed, somebody's asked, where can they buy the album?
Yeah, that was Paul that put the background music together. Can send a link after. One thing I did want to mention on that promotional video was that it mentioned Q2 completion date. From going on site and it being a very active hands-on site from the developer, we're expecting a March completion, so end of Q1, but I'll cover off the project in a bit more detail. So the project itself is a historic grade 2 listed building. So for us, when we do look at particular developments, if it doesn't necessarily offer as great value and it's a must from us, the project itself has got to offer character, because we are thinking medium to long term what the exit strategy would be. And given that a grade listed building can't be rebuilt from a new build with new cladding, etc., again, we just think that that's a massive tick in the box from a resale perspective on the medium to long term. The location, for anyone who isn't familiar with Burton on Trent, because I can appreciate it's not a location that everyone will necessarily be familiar with. You've got Birmingham to the bottom of the page and Nottingham, which Burton on Trent sits right in between Derby, Nottingham and Birmingham. So location is right in the heart of the Midlands, but we are looking, because both cities, Birmingham and Nottingham, have been performing very well over the last 5 to 6 years. We're looking for that overflow again. Connectivity, East Midlands Airport, Birmingham and Nottingham City Airport are well within 15 minutes commute of this location. Again, before actually kind of taking Burton on Trent as a location of interest, we needed to understand what money would have been allocated. Now, this was a Cushman and Wakefield appraisal that was basically put together by East Staffordshire Borough Council and the Staffordshire County Council in a pledge for funding. So this was a 62-page document, which basically goes into detail on Burton and the real key attributes. Now, they just mentioned about the location being the heart of the Midlands. It's part of the National Forest, so again, very green, very high on the tourism end of tourists coming in to actually see historic breweries and the National Trent. And obviously it's got part of the National Trent, which is close by water. So this documentation that was submitted to the government meant that they were awarded £25 million in terms of improving the local town centre. And they were then awarded another £42 million in terms of improving infrastructure. Again, just improving connectivity and demand for Burton on Trent. Now, I thought I'd include this image as mentioned, it's part of the National Forest. Now, being mindful of coming off the back of COVID and what Pardeep can kind of justify in terms of where the demand is, typically what you will find is that Burton on Trent will offer 3, 4, 5 bedroom plus detached houses. So we've gone really against the grain looking at apartments that are priced very competitively and is in real demand for local corporations. But that should give you an idea in terms of how green Burton on Trent genuinely is. And again, some real good culture and history. This was built in 1889, but a real kind of interest from a tourism perspective. Another key point is that Burton on Trent is the brewery capital of the world. Now, Molson's Coors is a global company, but headquartered in Burton on Trent. Employs over 25,000 people and has a valuation of over 10.5 billion. Right in Burton on Trent, you've got 2,500 employees, which as an average wage, you're looking at £60,000 plus. So again, real good in terms of culture, but in terms of the potential tenant pool, very, very strong. Because you are very close to Nottingham, Derby and Birmingham, you have access to over 27,000 students with over 300 study programs. With that said, I'll show you a quick internal video panning around the courtyard, because for us, looking at the amount of natural light coming through and what will be delivered on completion is really key when we made a decision to take this project on.
And just to add a little bit on that, why we're looking at this video, so that there's a term that everyone's a bit more familiar with now. It's a term called borrowed light. And if there's any element of borrowed light, i.e. not enough windows coming into certain rooms in the house, again, lenders on the back end come to completion, they don't like them. So they'll get a zero valuation because that term borrowed light. So you can clearly see with this, as all of the windows will remain, they're actually knocking the wall through on the other side of the building to add even more light. So we go through floor plans in very fine detail when we onboard projects. And one of the things we're looking at almost immediately now, once it goes past the initial due diligence, is that borrowed light element. Because again, if there's an element of borrowed light, there'll be no lending for that particular unit. So again, just to mention that, 'cause it's another important point and a part of our onboarding process.
Yeah. And I think what would be key to kind of highlight is that AG Construction, they have their own internal construction arm, so AG Construction, so everything is in-house. Now, this is one of their flagship developments. We are looking at a number of projects moving forward with them, but in terms of work that's progressed since we first looked at the site, on track, and we're very proud to be working with these guys. So in total, there are 40 units in the Plough. We have access to phase 1, which is 32 units. Now, we launched this project about 3 weeks ago. We're now going out to our main partners in the wealth management space. But just to give you an idea in terms of what has been of kind of most interest from initial launch, was the larger 2 beds, simply from my opinion that you're getting more bang for your buck. If you're comparing this to the likes of Birmingham at £282 a square foot, pretty similar to Manchester, north of £500 a square foot. If clients were looking for a 1 bed in Manchester, in Birmingham, you could be looking to secure a 2 bed here and just really get a lot more value for your money. Now, without going into too much detail on it, I did want to pass over to Pardeep because, again, we've done a pretty thorough rental appraisal, and pretty similar to Bolton, we're looking at north of 6%. So Pardeep, I don't know if you wanted to talk a bit more about the tenant profile and the projected yields that we anticipate.
Definitely, thanks, Reece. So as mentioned, we've been on site a few times, and it really is a gorgeous building. The big arch windows, the feature beams, all of this is going to further serve to attract tenants to this development in particular. Lots of open green spaces, and when talking about open spaces, the apartments themselves are actually a really good size as well. So it ticks lots of boxes for tenants. Burton's quite an exciting proposition, really. The economy within Burton itself and the demographic of tenants within Burton it is really solid. So like Reece has mentioned, we've got Molson Coors, really big employer, employing 25,000 people, and there's set to be an extra 21,000 new jobs created in Burton itself by 2028. Not only that, but Burton serves as a great commuter town as well. So we've seen how close it is to Birmingham, Derby, Stafford, Uttoxeter, and that area of the Midlands is home to some of the biggest automotive, aerospace, and engineering manufacturing companies in the UK. So kind of JCB, Rolls-Royce, Jaguar Land Rover, they're all situated within a 20-mile radius. So we have a really strong pool of professional tenants here to pull from. Again, to mention on parking as well, with it being the higher end of the tenant demographic we're targeting, and with a lot of these employers being within drivable distance, parking again here will be really, really important. And just to mention and just to touch on the student side of things as well. So, we have a student population of about 27,000. And I think it's important to mention that, whilst we might not be directly targeting the student market, any residential town, city that has a strong student market is always great for the residential lettings market, because they'll put pressure on the market, in season, in term times and things like that. So that only strengthens the rental profile within the town.
Yeah, and I think just to add on that, what we were looking at was the retention of these regional cities, Birmingham, Manchester, retaining postgraduates. So historically, university campuses in your regional cities, once a student would graduate, they would relocate back down to the capital. With that becoming too unaffordable, as long as we can retain a larger proportion of postgraduates, this is really going to have a knock-on effect on house prices and rental demand. So it's not necessarily saying, like Pardeep mentioned, that this is going to be targeted towards university students. It's about the medium to long-term play that will have on purchase prices and rental demands. I did want to just cover off or finish off with a quick cash flow. Now, these can be available for every single unit. This is taken on a large one-bedroom apartment, 58 square feet. So to the top left, £157,000. Now, in total, if we are looking at, let's call it a 70% mortgage from start to finish, you'd be looking at around about £55,000. Now, in terms of reserving and an exchanged amount, you'd be looking at just over £33,000. But what is important for me, and kind of bearing in mind Darren's comments about conservatively looking at around about a 4% interest rate, if we scroll down to the bottom, estimated gross income, you're looking at £800, so a gross 6.1%. With a virtual freehold, so no ground rent, and service charge at £2.25 per square foot, servicing your mortgage, you're still going to be cash flow positive, around about £232. So leveraging high in this particular development, locking in interest rates where they are still very competitive, you're still going to be cash flow positive. So for more details on that, and if this project is of interest, please do speak to your consultant, and we can talk through the project in a lot more thorough detail. But just to give you an idea in terms of the financial breakdown. And if we were to compare it to something from a rental standpoint, this is in St Paul's Square, so central Birmingham. Now, this is a very similar like-for-like project, so a refurbishment of a grade 2 listed building. But for a 2-bedroom, paying £2,200, again, you're looking at half the price comparing it to Burton on Trent. So for us, taking all of this information and looking at the comparables, we really want to make sure that it's going to be sustainable over the medium to long term. Completion, as mentioned, is due Q1 or March of next year. And for me, that's pretty much a summary on the 2 developments that I think right now should be of great interest for clients who are looking to either diversify or add to their property portfolio. But Chris, I don't know if there's any more questions that have come through for either.
Reece, thanks very much. Great presentation, and thanks everyone for sticking with us. One question came up. I saw your webinar a few weeks back on the holiday cottages. Are they still available? Can they contact you? Yes, down in Dorset, whether
yeah, they are. We've got in Stoneleigh Village, there's 5 units left, and we're close to planning, which will get probably towards the winter for another 79 units in Bude phase 2. So yeah, very active in that space still.
That's great. I'm conscious of time. One thing that came out when Reece was talking about foreign exchange. We have a partner, Rebecca Hooton. Please use her. She gets better rates than your bank, who like to steal money from you. So use her. And obviously got Darren on there and Donna, mortgages, and something we didn't mention, pre-approvals for mortgages. Please, if you've got clients, or you are indeed a client looking at this, if you want a pre-approval for a mortgage, then contact us, contact Darren, and get peace of mind more than anything else. Yeah. Apart from that, and that's all the questions. We've answered all the questions. This will be on our website. This recording will be on our website, along with many award-winning shows that we've done in the past. So please have a look at that. Paul, always a pleasure. Reece, Pardeep, you're welcome back every week, no matter, even if it's not Global Residential. And Darren, you're always there. Fantastic. Thank you, everybody.
Thank you very much. Thanks, Chris.
Thank you, guys.
Bye-bye.
Cheers.
Bye now. Bye.